I welcome back. So look at the key financial statement and also download the financial statement from the NGX and a company website. So how are those three key financial statements? How are they connected? How are they linked to each other? Recall that we have the income statement, the balance sheet, and the cash flow statement. So let's look at how they are connected. So the relationship between the key financial statements, we have the income statement, the statement of cash flow, and the balance sheet. The income statement is linked to the statement of cash flow through the profit before tax. So through the profit before tax, you see how a financial is prepared. Through the profit before tax, which is actually brought down to the statement of cash flow, then we're going to be making some adjustments. Some of them include the non-cash adjustments, which include the depreciation and amortization that are an estimate in the income statement. The income statement and the balance sheet are prepared on an accrual basis, and the cash flow is actually prepared on cash flow basis. We're actually looking at the cash inflows and the cash outflows from an organization. So what we need to do is to make adjustments to this profit before tax, which is linked through the income statement. And at the end of the day, we're going to be having our cash and cash equivalents for the year and our cash and cash equivalents at the beginning of the year, which we are going to be using prior year financial statement or prior year from previous year financial statement. So this is the closing balance of cash from the prior year, which is 2024. Then it's going to serve as the opening for 2025 financials. So the addition of these two is going to give us our cash and cash equivalent at the end of the year. The cash and cash equivalent at the end of the year is going to flow down into the balance sheet at the end of the period. It's going to flow down to the balance sheet at the end of the period. So your statements of cash flow is linked to your balance sheet through your cash and cash equivalent at the end of the year. Your statement, your balance sheet rather, is linked through your income statement through the written earnings. Is linked to your income statement through the written earnings. So how is it linked through the written earnings? We have our statement of written earnings here. We have the opening balance of written earnings, which is the prior year closing balance, which is brought down to this year as the opening balance. Then we make some adjustments, which include the addition of net income, the net income which is coming from the income statement. Yeah. Then we have the deduction of the dividends paid during the year, which is a new reduction. So at the end of the year, we are going to be having a closing balance, which is then transferred to written earnings in the balance sheet. So that's how the three key financial statements, that is how they are connected to each other. The income statement is linked to the statement of cash flow through profits before tax. The cash flow is linked to the balance sheet through cash and cash equivalents at the end of the period. While the balance sheet is linked to the income statement through net income, which is adjusted under the retained earning. Those are the relationship between the three key financial statements. Like I always emphasize, those are crucial for you in your financial analysis and in your financial modeling when you're modeling an organization or a company. So you know how they are connected to each other. It's going to help you. It's going to aid you. Thank you. We'll meet in the next video.